is George Barrow. I'm a fund manager in the financials team. I'm here to give an overview of the Polar Capital Financials Trust and how we see the outlook for the financial sector. Just to give a brief background of the trust, it's one of 4 funds run by the global financials team. It was launched in 2013 as a low-risk way to gain exposure to the financial sector. It has a 100% tender offer every 5 years at 99% of NAV. And it has both an income and growth mandate. The current yield is 3.3%, and it has the ability to use gearing, which is currently around 12%. We have periodically bought back shares when the discount has widened, and typically when it reaches high single digits. In terms of performance, the trust has outperformed MSCI Acqui Financials, outperformed its Lipper peer group, and we've included the performance of UK large cap banks, as the trust was designed to offer an alternative to investors who might otherwise have invested in the sector through 1 or 2 UK banks. However, financials have underperformed broader markets since launch, as noted at the bottom of the table, and that trend has been exacerbated by the performance this year. So focusing on bank performance this year, that underperformance relative to broader markets has been wider than at the low point of the global financial crisis, as highlighted by the 2 charts on the slide. Now, this has been driven by concerns on the extent to which asset quality would be impacted by the health crisis. Regulatory restrictions on capital return have also weighed on the sector, as has the lower rate environment and political risk with events like Brexit negotiations and US elections. However, while we accept that uncertainty remains, we believe the performance is at odds with fundamentals, and recent data has raised our confidence in the resilience of the sector. Consequently, current valuations, we feel, are more a reflection of investor experience in the previous cycle during the financial crisis than what we're seeing currently. Given the recovery catalyst we view from reopening of economies as COVID-19 fades, as visibility on asset quality improves, and as capital return restrictions are lifted, we believe that current valuations offer a very attractive entry point into a sector which is a key part of the value rotation trade. So this slide focuses on asset quality, and in terms of what we've seen, there has been some increase in non-performing loans, but as the graphs show, they remain at relatively low levels, and particularly in relation to what we had seen at this point in the downturn last cycle, as highlighted in the left-hand chart. In contrast to the run-up to the financial crisis, loan growth had been at relatively low levels running up to the downturn, running at around 2 to 3% annualized for European and US banks respectively, and credit controls had already been tightened. So consequently, there's been less risk added onto balance sheets ahead of the downturn, and that's always a good predictor of future stress in the sector. Another key difference to the situation last cycle is that loan loss provisioning has been front-loaded following accounting changes. The banks now make provisioning on an expected loss basis rather than an incurred basis, and therefore the impact to the P&L is taken at a much earlier stage. In fact, JP Morgan's CEO has estimated the bank is over-reserved by around $10 billion should the Fed's base case economic scenario play out. A recent indicator that's increased our confidence on the outlook has been the latest trends in deferral loans. So as part of state support in response to the pandemic, many borrowers were granted temporary payment holidays or deferrals on loan repayments. There was concern initially that a lot of these loans would migrate to non-performing, leading to a material impact on the banking sector through higher provisioning. As the graphs highlight, we have seen a material fall now in deferral loans in the third quarter. And importantly, the vast majority of customers that have exited deferral periods have reverted to full repayment. So JP Morgan noted that of its consumer loans that have exited deferral periods, 92% have reverted to performing loans. Turning to HDFC Bank in India, another core holding in the fund, management noted that collection efficiency is expected at 97% in October, so close to the pre-COVID levels of 99%. So this trend has significantly improved the visibility on the asset quality outlook and raised our confidence that we've seen a peak in loan loss provisioning. Now, this has been something that management have been guiding for, but this trend has given us more confidence that we've seen the peak. So consequently, we expect earnings growth next year to be supported by a normalization in provisioning, having front-loaded the impact in 2020. Now, a key factor in the sector's resilience has been the speed with which governments have implemented large-scale stimulus packages. So these range from direct cash payments, as seen as part of the US CARES Act, furlough schemes subsidizing salaries, and government-guaranteed lending. So as highlighted by the left-hand chart, the fiscal stimulus this downturn has been significantly larger than seen during the financial crisis, and in contrast to the last downturn, these stimulus measures through government-guaranteed lending have led to a significant acceleration in broad money growth. In fact, it's now at its highest level in the US since the Second World War. Now, clearly there are concerns about the extent to which trends deteriorate once stimulus fades, but we've been encouraged by recent asset quality data, particularly on those borrowers that have exited deferral periods. And we've seen with recent policy actions that governments have been willing to support economies through additional stimulus should COVID force renewed restrictions. So a key reason why the sector is better positioned to weather a downturn is that balance sheets are now significantly stronger. So we've had tighter regulatory restrictions that's led to higher capital ratios, and that capital build has also been supported by low levels of loan growth running up to the downturn, and more recently by capital return restrictions. So the building in capital levels can be seen in the chart on both the left-hand side, looking at Europe and the US, and more broadly for the sector on the right-hand side. So unlike the situation in 2008 and 9, when numerous banks were forced into diluted capital raises, we've seen surplus capital continue to be built in 2020. So we're now going through a real live stress test for the sector, and I think that has longer term implications for the regulatory environment and how they assess the sector's ability to withstand the shock, as well as the cost of capital that's applied to the sector. And to date, trends have shown a greater resilience than expected. So this slide highlights the material amount of surplus capital expressed as a percentage of market cap that can be returned to shareholders once restrictions are lifted. So on average, surplus capital is around 15% of market cap for US banks and around 40% of market cap for European. It's important to note that US banks have continued to pay dividends throughout this year, although they've been restricted on buybacks. But numerous other regulators have placed restrictions on both dividends and buybacks. We expect the lifting of these restrictions to act as a strong catalyst for recovery, with banks in a position, we feel, to sustain a high level of capital return. Regulators are set to make a decision towards the end of this year, and while the exact timing is unknown, it could be that they make a decision in December to lift it, or it could be towards when full year results are reported in March. We feel the level of surplus capital, improved visibility on the asset quality outlook, and with macro trends running ahead of initial estimates when the restrictions were put in place, raises the probability that we revert to a normalized environment where the regulator assesses banks on a bank-by-bank basis, and with the stronger banks being able to return and sustain a high level of capital return. So moving to different segments of the trust, emerging markets has risen as a proportion and now represents 26% of the trust. This has risen from around 13% at the end of last year, and Asia remains the dominant part of our emerging market exposure. We have seen a divergence in performance within emerging markets, with North Asia outperforming earlier on, reflecting their greater success in containing the virus, as well as the region's bias towards technology-related exports. However, overall in Asia, we are seeing a faster economic recovery from the pandemic, and longer term, continue to view an attractive growth outlook, particularly in South and Southeast Asia, reflecting lower levels of penetration, as shown by the right-hand chart, and as the left-hand chart highlights, attractive profitability, and which we expect to remain well ahead of developed market peers. Fintech represents around 10% of the trust and is predominantly held within the payment space. So companies include MasterCard, PayPal, and Adyen. We are seeing the current healthcare crisis accelerate the structural shift out of cash, with payments the key beneficiary of that trend. Focusing on PayPal, The graph shows the acceleration in terms of net new active accounts. And in the third quarter, these rose over 50% year on year to add 15 million new accounts in the quarter. It is down slightly from the amount that was added in the second quarter, but still a significant rise, and we expect the behavioral shift to be durable. So with cash still representing 80% of transactions by volume globally, we expect growth to remain strong in this area for a long period of time. However, we have seen a material re-rating in the payment space this year, in line with the broader strength in the technology sector, and consequently, we have taken some profits on certain fintech holdings, and that's created room for us to raise exposure in other areas, primarily within the banking sector and to a lesser extent within non-life insurance. Slide 12 looks at M&A. This is a theme we expect to become increasingly prevalent, and this year we have seen a pickup in activity across the banking and non-life segments. Recent M&A in the US has included PNC's acquisition of BBVA's US business, which is expected to be over 20% accretive to earnings in 2022. Given the trust's quality bias, we tend to own the acquirer rather than the acquired, although we've given some examples on the right-hand side of stocks that we've owned that have been acquired, that have been held in the trust. Those include challenger banks such as Shawbrook and Aldermore, and some non-life holdings. Given that there are still over 5,000 banks in the US, and given the pressure on the industry to improve efficiency and offset some top-line headwinds, we expect to see a continued increase in M&A activity. The clear trend that's emerged in 2020 has been an acceleration in upward pricing trends in non-life insurance. As the left-hand chart shows, this rose 20% year on year in the third quarter, up from 19% in the second and 14% in the first quarter. Following a derating in non-life insurance stocks earlier in the year, we raised our proportion in this area, which is now 14% of the trust, up from 12% at the end of last year. Our overall insurance exposure has risen to 22%, up from 17% in 2019. So following the increase in primary and retrocessional rates, we are now seeing and have seen a hardening in reinsurance rates, reflecting reduced capacity, higher losses, and tighter underwriting. Now, there are concerns on business interruption losses, and that's weighed on certain non-life insurance stocks. However, we are now getting more visibility on potential losses in this area following court rulings. And with capital levels strong and valuations attractive, we view strong recovery potential within this space. So moving to valuations on slide 14, as the left-hand chart shows, bank valuations are at or close to historic lows. We think there is significant recovery potential there. And as the right-hand chart shows, non-life has seen a significant derating this year. As shown in the charts, banks were last at this price-to-book level during the financial crisis when there were systemic risks around, and there were also questions around solvency levels for the banks. As we tried to highlight in the previous slides, banks are now much more resilient given the strengthening in their funding and capital positions. And the fact that we're talking about when banks will be allowed to return surplus capital demonstrates how different the environment is now relative to the last crisis when we saw numerous dilutive capital raisings, and yet they trade at a similar price-to-book multiple. Looking at the very recent performance, we have seen early evidence of rotation. And the left-hand chart shows that bank stocks have been a particular beneficiary during this rotation. So we've looked at different MSCI ACWI indices during November month to date. As noted, we've shifted some of the portfolio towards the banking sector, and the right-hand chart shows the performance of our largest 15 holdings during November, with the banks showing particularly strong performance. So we are potentially in the early stages of a durable rotation and continue to view material recovery potential, with catalysts from improved macro expectations, supported by vaccine developments and a reopening of economies. This will feed into greater visibility on asset quality and the provisioning outlook. And while a lifting of restrictions on capital return, we also feel is a strong catalyst for the sector. Finally, to give a quick snapshot of the portfolio, banks make up around half of the trust. And as noted, this has been rising as a proportion. And given the movements in November, this is probably more like 55% today. We've also raised our exposure to emerging markets. As noted, that's around 26%, and that's been offset primarily by a reduction in our US exposure, which contains the majority of our fintech exposure, where we've taken some profits. These changes have increased the fund's positioning for a recovery in value. We've also raised the gearing on the trust to around 12% from 4% in 2019. Thank you for your attention. And if you have any questions on the sector or the trust, please get in touch and we'll be very happy to answer.